The Central Bank of Nigeria Governor Godwin Emefiele is now speaking at a press briefing on decisions of the Monetary Policy Committee. We now cross live to the session for the decision of the Apex Bank.
Factors include tightening global financial conditions, declining global trade, and increasing risks of a financial meltdown owing to the burgeoning global private and public debt portfolios. The committee reviewed this and other developments in the global and domestic economies in the third quarter of 2022, as well as the outlook for the rest of the year. All 12 members of the Monetary Policy Committee attended this meeting. The global developments. The committee expressed concern over the heightened risks of spillover associated with broadly weakening global recovery. These have been further exacerbated by uncertainties emanating from lingering supply chain bottlenecks due to Russia-Ukraine war and continued COVID-19 lockdown in China. Consequently, global trade maintained a steady decline while inflation remained unabating despite progressive rate hikes by several central banks. The risk of yet another global recession will be extremely damaging for fragile economies still confronted with the lag impact of the 2020 recession, especially for emerging markets and developing economies currently confronted with huge capital flow reversals and tightening global financial market conditions. Consequently, the IMF, International Monetary Fund, in its July 2022 growth forecast further downgraded global output growth for 2022 and 2023 to 3.2% and 2.9% respectively, from 3.6% apiece. In the advanced economies, inflation remained high and considerably above the long-run objectives of several central banks' threshold despite progressive rate hikes, due largely to a persistent increase in the prices of food and energy. In major emerging markets and developing economies, the uptrend in inflation is expected to continue in the medium term, driven by legacy structural issues, elevated exchange rate pressures, rising capital flow reversals, in addition to the outlined shocks from the global economy. In global financial markets, investors have continued to rebalance their portfolios as yields on fixed income securities improve with the ongoing policy rate increases. Gold prices are thus gradually declining as investors move steadily towards the fixed income markets. In addition, risk-averse portfolio investors have continued with reassignment of their portfolios from perceived riskier emerging market securities to less risky advanced economy securities. Domestic development. According to the National Bureau of Statistics (NBS), real gross domestic product grew by 3.54% year-on-year during the second quarter of 2022, compared with 3.11% in the first quarter of 2022 and 5.01% during the corresponding quarter of 2021. The economy has thus maintained continuous growth for 7 consecutive quarters, following its exit from recession in 2020. This consistent positive performance was driven largely by the sustained growth in the non-oil sector, particularly services and agricultural subsectors, supported by continued policy interventions as well as credit expansion to the private sector. While output growth remains positive, the committee was concerned about the contraction in economic activities as indicated by the Composite Purchasing Managers Index, which fell to 47.2 index points in August 2022, below the 50 index points benchmark, compared with 50.4 and 51.9 index points in July and June 2022, respectively, an indication of a weakening output situation. The contraction was attributed to a decline in production levels, new orders, inventory levels, unemployment levels, and persisting shocks from the global economy associated with both Russia-Ukraine war and the unabating pandemic, as well as other domestic shocks. The committee, however, expressed optimism on the economy's recovery in the short to medium term in view of the unwavering support by both the monetary and fiscal authorities in Nigeria. The committee noted the continued uptrend in inflation for the 7th consecutive month, with headline inflation year-on-year rising to 20.52% in August 2022 from 19.64% in July. Both the food and core components rose to 23.12% and 17.2% in August 2022 from 20.02% and 16.26% in July 2022 respectively. The hike in energy prices, such as rising price of automatic gas or AGO, hike in electricity tariffs, as well as the perennial scarcity of premium motor spirit PMS, contributed significantly to the building of expectations, thus pushing up the cost of transportation and production. Other contributory factors include the broad-based insecurity across the country, which continue to dampen production activities generally, legacy structural factors such as inadequate state of critical infrastructure, high cost of importation of essential grains such as wheat, and increased demand for money associated with the forthcoming electoral campaign season. The ongoing monetary policy tightening by the US Fed is also putting upward pressure on local currencies across the world, with pass-through to domestic prices as investors exit these economies to seek higher yields in US dollar-denominated fixed income securities. The committee noted that broad money supply M3 grew by 11.05% in August 2022 compared with 8.66% in July. This was driven largely by the growth in net domestic assets NDA of 26.19% in July 2022 compared with 22.78% during the preceding month. The sustained growth of the NDA was driven largely by increased claims on the federal government and other financial corporations and the private sector. Money market rates continue to fluctuate, reflecting liquidity conditions in the banking system. Consequently, monthly weighted average open buyback OBB rate declined to 13.21% in August 2022 from 14.15% in July, while the interbank call rate increased to 15% in August 2022 from 13.00% in July 2022. Capital adequacy ratio and the liquidity ratios remained above their prudential limits of 13.4% and 40.1% respectively in August 2022. The committee applauded the improvement in non-performing loans (NPLs) ratio to 4.8% in August 2022 compared with 5.0% in June 2022, reiterating its call on the bank to sustain its tight prudential regime to ensure that NPL ratio is kept below its 5% prudential benchmark. The MPC noted the development in the equities market in the review period as all-share index decreased to 49,836.51 index points in August 31, 2022 from 51,817.59 index points on June 30, 2022. Market capitalization also decreased to 26.88 trillion naira from 27.94 trillion naira during the same period. The bearish performance reflected sustained profit-taking and sell-off by investors rebalancing their portfolios in favor of higher yields in the fixed income market. The committee noted the marginal increase of 0.39% in the level of external reserves to $38.46 billion as at the end of August 2022 from $38.31 billion at the end of July 2022, despite continued demand pressure. With crude oil price forecast to continue to moderate in the short to medium term, members urge the bank not to relent on its various policies put in place to support non-oil exports, in order to shore up external reserves. Under the real sector facility, the bank released a sum of 66.99 billion naira to 12 additional projects in the manufacturing and agri sector. These funds were disbursed from the real sector support facility from the differentiated DCRR requirement component of the facility. Cumulative disbursements under the real sector facility currently stands at 2.1 trillion naira, disbursed to 426 projects across the country. Furthermore, under the 100 for 100 policy on production and productivity, the bank disbursed a sum of 20.17 billion to 14 projects in the healthcare, manufacturing and services, bringing the cumulative disbursement under the facility to 93.39 billion naira to 62 projects. In the healthcare sector itself, 44 billion naira was disbursed to two healthcare projects under the healthcare sector intervention facility, bringing the cumulative disbursement to 130.54 billion naira to 130 projects comprising 32 pharmaceuticals, 60 hospitals, and 39 other services. Under the export facilitation initiative, the bank funded several community projects in the non-oil export for value addition and production to the tune of 3.28 billion. And this is aside the over 50 billion disbursed through the Nigerian Export-Import Bank (NEXIM). The micro, small and medium enterprise MSME sector, the bank supported entrepreneurship development with a sum of 39.26 million naira under the Tertiary Institutions Entrepreneurship Scheme, bringing the total disbursement under this intervention to 332.43 million naira. Under the intervention facility for the National Gas Expansion Program, the bank disbursed 1 billion naira to support the adoption of compressed natural gas as the preferred fuel for transportation and liquefied petroleum gas as the preferred cooking fuel. Our outlook. The broad outlook of the global and domestic economies in the medium term remains clouded by uncertainties associated with lingering headwinds from the Russia-Ukraine war and the residual impact of the COVID-19 pandemic. Others include tightening global financial conditions with elevated shocks to foreign capital flows as some advanced economies continue to pursue aggressive policy rate hikes, the high level of corporate and public debts with heightened risk of another global financial meltdown, and the high level of inflation across several economies. On the domestic front, available data on key macroeconomic variables indicate that output growth will continue for the rest of 2022, however, at a much subdued pace. Some of these domestic shocks include the high level of insecurity currently disrupting the free flow of economic activities, heightened sovereign risk as the 2023 general elections approach, continued upward pressure on inflation driven by exchange rate pressure amongst other domestic factors. In addition, domestic price development is expected to maintain the current upward trend in light of the build-up of increased spending and demand for money as the 2023 general elections approach. Accordingly, Nigerian economy is forecast to grow in 2022 by 3.52% CBN estimate, 4.20% by Federal Government of Nigeria estimate, and 3.4% by the IMF estimate. The committee's consideration. Ladies and gentlemen, at this meeting, the focus of the MPC was on the aggregate aggressive acceleration of inflation globally and how this had begun to retard growth in both advanced and emerging market economies. Members noted that though the global economy was progressively weakening due to the various headwinds surmounting the recovery, in Nigeria, output growth had been sustained as a result of the combination of development finance interventions by the bank and fiscal stimulus by the federal government. Members noted that in the last 3 years, the CBN had injected over 9 trillion naira into the economy, in addition to offering 2-year moratorium for 10-year long-term loan facilities. The committee believed that these interventions have significantly helped to engender growth. However, in light of the persisting pressures of inflation, the committee encouraged the bank to maintain a close watch on the inflationary implications of these interventions. The MPC noted the moderate downturn in the equities market, attributing it to a continued outflow of portfolio capital as investors reassigned their portfolios to more attractive US dollar denominated fixed income securities. The committee, however, also called on the federal government to continue to improve the ease of doing business in Nigeria, to retain the current patronage of foreign investors through sustained investor confidence in the Nigerian economy. MPC applauded the bank for its continued stringent regulatory measures over the banking system, noting the progressive decline of the non-performing loans NPL ratio of the banking system despite the heightened macroeconomic uncertainties. MPC was concerned that within a 4-month period, inflation had accelerated aggressively by 280 basis points from 17.7% in May of 2022 to 20.5% in August 2022. The committee was consequently of the view that given the primacy of its price and monetary stability mandate, it is expedient that the focus must be to rein in inflation at this time. The committee was therefore of the view that a hold or losing option was not in consideration at this meeting at all. This is also because a loosening will further widen the negative real interest rate gap and worsen the financial market conditions as savings mobilization, investment inflows will decline further. It was also of the view that with the aggressive policy normalization in advanced economies, loosening the stance of policy would result in a sharp depreciation of exchange rate, leading to further hike in capital outflows. As regards a hold decision, a hold would mean a continuous deterioration in real earnings of fixed income earners and the livelihood of middle and low income households. The MPC noted that a tight policy stance would help consolidate the impact of the last 2 policy rate hikes, which is already reflected in the slowing growth rate of money supply in the economy. It also felt that an aggressive rate hike would slow capital outflows and likely attract capital inflows and appreciate the naira currency. Committee's decision. Members deliberated on the impact of the widening margin between the current policy rate of 14% and the inflation rate of 20.52%. At this meeting, the option to loosen the policy rate was not considered, as this would be gravely detrimental to reining in inflation. The committee thus agreed unanimously to raise the policy rate to narrow the negative real interest rate gap and rein in inflation. Committee thus voted unanimously to raise the MPR. 10 members voted to raise the MPR by 150 basis points, 1 by 100 basis points, and 1 by 50 basis points. 10 members voted to increase CRR by 500 basis points, while 2 members voted to increase it by 750 basis points. In summary, the MPC voted to 1. Raise the MPR to 15.5%, retain the asymmetric corridor at plus 100 and minus 700 basis points around the MPR, increase the cash reserve requirement ratio CRR to a minimum of 32.5%, and 4, retain the liquidity ratio at 30%. Thank you for your attention.
Thank you, Governor. That was the communique number 144 of the 287th meeting of the Monetary Policy Committee of the Central Bank of Nigeria, held yesterday and today. between the 6th and 27th of September 2022. We will be taking questions from the press, but as would be expected, Paris decisions taken this weekend, and I know that most of you will want to ask questions. So what we'll be doing, we will take a number of questions here, but tomorrow morning by 9 a.m., we will go kind of granular discussion to be led by the Director of Monetary Policy Department and Secretary of the NBC. And all members of the technical committee will be at that meeting. And so, tell us your name, and then the media house you represent, and then we'll proceed.
Thank you, sir. Good afternoon, Mr. Governor, members of the NBC. I'm Nancy. This is a wonderful moment, really, because I think this is the first aggressive nature that I've seen central bank in a long time, raising interest rates by this time. My question is really, with this way that FPC has gone, does that mean that whenever inflation rises, that the FPC will increase interest rates, just like we've seen across the world among Feds and central banks across the world? Will increasing interest rates also, will it likely lower inflation? Then the third part of my question is, with this decision, Governor, how confident are you and how certain, how sure are you that this will not likely depress the economy and Nigeria's GDP? Thank you.
Good afternoon, Mr. Governor. My name is Vice Nation Newspaper. So, recently, the Nigerian Bureau of Statistics released inflation figures. Now, inflation is about 20.52%. Mr. Governor, sir, we know that this is a global challenge. When do you think we will begin to see a deceleration in inflation in Nigeria? Thank you very much.
Good afternoon, Mr. Governor. My name is James, a major witness. Recently, on the sidelines of the United Nations General Assembly, you mentioned that non-oil exports, the proceeds from non-oil exports increased to about $959 million. Given this, that is in the third quarter of 2022, what are you going to do to make sure that this feat is sustained? And my second question, sir, the bank recently stepped in to help checkmate what would have been a major setback in the international travel from Nigeria, with the release of $265 billion to airlines to settle outstanding ticket sales. Are we expecting more of this from the CBN to ease their travel? Thank you, sir.
Good afternoon, Mr. Governor. My name is Sectoral. I work for the Telegraph newspaper. The e-naira will be 1 year in movement, precisely. What sort of feedback do you get, given that it's a novel idea that is very important?
And also, Governor, I have a number of questions from people who send their questions online. This one is coming from Babajide Komolafe. And he says, the e-naira hackathon was adjudged to be a huge success. Considering the number of entries and the innovative ideas brought to the fore by young Nigerians, is the bank considering tapping into the technological knowledge base of these youth in future innovative ventures in Nigeria's financial system, particularly in the payment system? The next one is from Numen, Academy of this day. The question is, when you launched the RT 200FX program in February, you said the summit will be held biannually. What are the outcomes of the maiden summit held in June 2022? Are we expecting another summit before the end finally from Collins, the nation. Governor Sir, with the worst of the COVID-19 pandemic now behind us, the bank recently reverted interest on all its interventions from 5 to 9%. Observers are keen to know what the impact of these interventions are. Thank you, sir.
Let me thank all of you for these questions. The first question, which came from Nancy, raised issues about the fact that there's a lot of worries about inflation trending upwards globally, and wants to know, and first ask the question that will MPC continue to raise rates by or as long as inflation continues to go up? And the second part of our question is that how are we sure that raising rates will rein in inflation? And third, are we sure that this tightening will not ultimately reverse the GDP? On the first question, you all recall that at the last meeting that we held, which was in July, I was very clear in hinting that as long as we see inflation trending upwards, that I cannot, or that MPC cannot give any assurance to anybody that we will not continue to raise rates, because we've seen rates move recently very, very aggressively, and that is the reason we are following it up in the May, in the July, and now the September meeting very aggressively for us to ensure, to see to what can be done to rein in inflation. So again, Nancy, what I will say is this. My answer is that I cannot assure you or anybody who says you ask the question that we will not raise rates as long as inflation continues to trend upwards. The second part says, how am I sure, or how is MPC sure that raising rates will rein in inflation? I think it's important for us to know, to state that the time-tested monetary policy theory has shown that the one and the easiest way to tame inflationary pressure is to raise rates, and that is the most preferred options that have been adopted globally. And what does that also mean? That if you want to see the success in reining in inflation, you have to try as much as possible to raise your rate to a level that is equal or possibly even higher than inflation, so that your inflation rate must lag your policy rate. If your inflation rate does not lag policy rate or interest rates, you have to do so aggressively, because it results in what we call negative interest rate, which is itself a disincentive to investment. So when you ask the question, how am I sure? I will say, time-tested monetary policy theory says that this is the right way to go. The reason is because if you fail to raise rates because you are afraid that raising rates, in some cases like you said, or like you are seeing now already globally, even in the advanced economies, if you say you will not raise rates because it will retard growth, whether you like it or not, whether in the short run or in the long run, not raising rates will still retard growth as long as inflation keeps going up. So it is therefore imperative that you must raise rates in order to rein in inflation. Yes, it will retard growth, but it is important that you know that the raising of rate is what will help you to slow down the rate of inflation. And how will it eventually retard growth? You raise rates, you don't raise rates, you remain mute. What will happen is that consumption eventually you'll find that consumption and investment expenditure will be affected because purchasing power of the citizens or the consumer will erode and completely possibly dissipate. Or you will also see that once inflation continues to bite, what you can buy with, the quantity of goods you can buy with some money will reduce. And that is what also helps to increase the level of poverty in your country. So you don't have a choice but to raise rates. Our own study, our research study at Central Bank has shown us that once inflation trends above 12.5 or let's even say 13%, it will retard growth. We have seen inflation in the last 4 months move so aggressively in Nigeria. So it is difficult for us, for this MPC, with all the data available, with all the research that has been conducted, it is difficult for us not to go in the very aggressive way we decided to go today. We know to some it is not what is expected, because some of them will come out and say, look, we are trying to retard growth, it will make the cost of borrowing more expensive and the rest of them. But I can tell you that this is the best option at this time that we had to adopt. So now, how are we sure that decision will rein in inflation? I've already said it. We believe that it will. And what we have done at this meeting is to say we'll move CRR up by 5% to a minimum of 32.5%. That will move NPR up by 150 basis points. That means over the last 4 months, we moved NPR up by about 400 basis points. But at the same time, let's not forget that inflation rate in Nigeria at 20.5 is still higher than our policy rate. So which means we are still lagging. We are still in the realm of negative interest rate, which remains injurious to the economy. Now, what message do I have for the banks? We have increased the CRR, and we expect that this decision at this meeting must be seen to be potent and must achieve the effect that the MPC thinks it should achieve. What is the message? We expect that all the banks in Nigeria must fund their account by Thursday, 48 hours, because we will debit them for CRR. We will take their CRR to a minimum of 32.5%. So which means we are going to take liquidity out of their vaults by Thursday. If any bank fails to meet up with this expectation, the decision of the MPC is that we may need to, let me use may, we may need to preclude those banks from foreign exchange market on Friday and onwards until they meet this 32.5. This message is meant to underscore the fact that MPC says this decision, this very aggressive decision to rein in inflation must yield result. We do not want to face Nigerians in the next few months and we begin to take the blame for not being able to rein in inflation in spite of all the rates that we have raised. So we have decided to adopt a two-pronged approach. Increase NPR, so policy rates, so we want to see interest rate go up. And 2, CRR going up because we must mop liquidity effectively out of the vaults of the banks. The second question from Chejina says, how much longer before we begin to see a deceleration in inflation figures in Nigeria? Well, this will range from one economy to another economy. But our view is that the lag period should be between 2 to 3 months. So what are we saying? This is September. As we begin to get into November, into December and Christmas, we should begin to see it begin to decelerate. And we are going to do everything possible to achieve this. Because we believe that with the liquidity out, what will it do? It will constrain, yes, we know, it will constrain using money for speculative purposes, because we are not going to sit down and allow people to go into their bank accounts and take naira to speculate against the currency. We will not allow it, and that is the reason we will take the monies out of the vaults of the bank so that speculative use of naira can completely be tamed in the economy. About the hunger, he talked about the fact that non-oil export, that I said that third quarter non-oil export was as high as $950 million. And I think I need to thank the banks who have been our partners in this process of trying to see to how we can depend less on foreign currency coming from revenues from crude. We've always said that in Nigeria, before we found oil, that we were surviving and paying our import bills from revenue from non-oil sectors. And we started this around mid-February. Between that mid-February and end of March, we had seen non-oil export repatriation at $62 million. And during the second quarter, it moved up to $622 million. In the third quarter, the numbers that we see is $950 million. Let's not forget, these are repatriations that benefited or that will benefit from our 65 naira to the dollar rebate. By the time we take into consideration others, maybe crude cocoa, raw cocoa export or raw cashew exports, or products that do not have the kind of value addition that we think it should have, we would see that there's been considerable level of people embracing the non-oil exports as a way of doing transactions. And we are very hopeful that as this continues, we'll be running most likely in billions of dollars quarterly, and our expectation is that over time, we want to see people not coming to central bank to ask for dollars, but rather they will rely on dollars that are being sold by companies to other companies through their banks, through the I&E window. That is our ultimate goal, and we pray and remain hopeful that this is achievable. The fourth question talked about the airlines. Yes, but it's important for me to say this upfront on the airlines. The sector is a sector that had always enjoyed what we call priority allocation, whereas other, I use the word unimportant sectors, maybe you're importing finished goods, you're importing some items that we don't consider to be an item that contributes positively and in priority sector to the economy. Of course, you will observe that maybe they will get 10% or 15% at best. But for other sectors where they are priority, like the airlines, we've always granted them the kind of priority that they desire, because we know people want to travel and they don't want to be constrained by the need for them to travel. Yeah, in spite of this, we've seen that the number of travels or naira value of travels for tickets issued by the airlines has increased, and when the pressure was building aggressively, we decided to release the amount that you talked about $265 million. Now, will we? Yes, we will do everything possible, and we are determined to clear the backlog, and we will consistently at all the retail interventions. As long as the accounts of the banks are funded, we will continue to make the releases to ensure that the cumulative backlog is cleared. But I think it's important for me to say this, that the airlines or the foreign airlines are saying this because they said that we should respect the bilateral air services agreement that says that proceeds of all their ticket sales must be repatriated out of the country. It did not say that you must repatriate all your dollars through the central bank. There is no law that makes it compulsory that you must buy your dollars from the central bank. When you put your money in your account, what it means is that you tell your bank to buy you dollar. Your bank will go to the legitimate or approved sources, which in this case is the IRNA, to buy dollars and pay for your ticket sales proceeds. If they don't find, yes, they may resort to the CBN, but it does not mean that the CBN is under compulsion to provide the dollars. Because it's good for me to say this so that people don't just rest on the conclusion, not as a conclusion, that the CBN is under compulsion to provide the dollars. Another aspect of the bilateral services agreement I want to talk about is that we would like to appeal to the countries where the foreign airlines are domiciled or where their flights originate, that they should please, and we please beg them to give Nigerian airlines also a chance to land their aircrafts in their countries. Also in line with the bilateral air services agreement. You cannot be having 21 landing slots in a week from your country into Nigeria, and yet you have not given a Nigerian airline that wants to land its aircraft in your country even up to 7 landings. To us as Nigerians, this is unacceptable, and Nigerians must stand and criticize this, that it is not acceptable. What is the interest of the central bank here? When you give Nigerian airlines opportunity to land in your country, they pay, people who are traveling using these airlines will pay Naira. If they pay Naira, they will not come to the central bank or any bank to say they want to remit ticket sales. I have to be selfish to defend my country, ladies and gentlemen. The only thing they will go to their banks or by extension go to the CBN to say they need will be dollars to import planes or dollars to import spares or pay for the insurance, which is significantly lower than if they were to remit the entire ticket sales. So Nigerian airlines must be given also a chance to land equal number of planes in your country per week in line with the bilateral air services agreement. That is what we are begging for. Because we've heard about some of our airlines go to a country, they say they want to land. You have 21 landings here. Some of them have completed. We've read newspaper stories of where some of Nigerian people are saying that they were told by those foreign countries that don't even call us to remind us that we're not giving you approval to land. We'll tell you when we are ready. That is unacceptable because it is not in line with BASA. And I think that Nigerians must rise to demand the rights for Nigerian airlines. The fifth issue is on e-Naira. I'm asking for what is the feedback that we have received considering the fact that it will be 1 year. Well, some of the feedback I have here, yes, as we approach 1 year, is that we have almost hit 1 million mark on downloads, and so far 905,588 have downloaded their app, out of it 202,600 are currently active. So far, counts of transactions have exceeded 1.49 million, worth over 3.484 billion naira. And the breakdown is that 78,115 consumer to bank, worth about 1 billion naira. Bank to customer of 90,760 transactions, worth 945 million naira. Consumer to consumer transactions of what about value of number of about 35,800, what about 480 million naira, and consumer to merchants we've seen about 171,000 transactions worth over 387 million naira. We have seen downloads, 13,136 wallets have so far been created via the USSD channel. That was the channel we recently introduced about 3-4 weeks ago, and we are happy that progress is being made. So on the whole, I would say that for e-commerce, we have seen 99.946% increase between July and September, and this remains very encouraging. We believe the e-Naira is an alternative to you holding analog Naira, and it is very convenient, and we can almost say almost entirely costless. In the e-Naira hackathon that is CBN considering tapping into the technological knowledge base of this youth. Certainly, yes, we are, and we take the reason why we organize the hackathon project is for us to really discover our youths that are very versed in technology to support our e-Naira project or our digital currency, and it is expected that we would work with them to ensure that we tap their ideas so as to improve our payment system in Nigeria. Another question, the seventh question, says that what are the outcomes of the Maiden Summit? Like I said, the outcomes have been very good for the RT 200. We promised that there will be two summits in a year. We held one a few months ago, and I'm sure before the end of the year, the organizers will hold another one so that we can take stock and begin to also see people's views about how we can deepen non-oil export repatriation into the country. Lastly, on somebody asked a question that we recently reverted interest rates on intervention from 5 to 9%. Observers are keen to know what the impact of these interventions are. Like I said, we've so far disbursed about 9 trillion naira in interventions. And I needed to say that because I think that skipped me. The fact that we are saying that inflation is core and most important for us at this time does not mean that we would not continue to support very, very important and priority projects through development finance. But the pace at which we do so will certainly reduce, because we truly do want to see ourselves exiting quasi-fiscal responsibilities. So now, talking on the COVID-19 percent, we can say the outcome has been very good. We are happy about the outcome so far, that it has been extremely impactful in improving output growth in Nigeria, and we believe that with 10 years loan, with 2 years moratorium, 9%, that it will be difficult to see that again. And I congratulate those who have tapped into it in the last 2.5 years, to the extent that today we can beat our chest and say that we disbursed 9 trillion naira, 10-year loans with 2 years moratorium at no more than 9%. We have not started to see the impacts yet. And I can tell you, even notwithstanding the inflationary pressures we're going through, that is the reason we're optimistic, and we're saying that yes, growth is expected to be retarded by an aggressive rate hike, but we do not think that it will really affect Nigeria that much. And that is the reason you may have all read that Nigeria remains one country amongst very many in the world where the IMF has decided to retain our growth rate at 3.4%. So I thank you very much for your attention.
Thank you, Governor. Let me just
CBN Governor Godwin Emefiele just finished a press briefing on decisions of the Monetary Policy Committee. He says board members voted to raise monetary policy rate by 150 basis points to 15.5% in a bid to rein in spiraling inflation while retaining the asymmetric corridor. Arise business analyst Bode Oshosomi joins us now to give us a stake on the MPC outcome. Bode, thanks so much for joining us on Newsday. We just had the monetary policy decision. Was this what was expected?
Well, I dare say, indeed, many thought the tightening would continue, but I don't think many expected another 150 basis points in terms of the hawkishness. But I can understand where the central bank, of course, is coming from, apart from the fact that we are in the middle of a political transition, and the signs are there that there's going to be an inflationary impact. And of course, we've also seen the other drivers that are also more likely to take inflation even higher than the 20.5% that is already a disturbing number. The thing that is, of course, worrying, which the central bank is also trying to address, is the negative interest rates. A trend of real negative real interest rates is, of course, a red flag as far as investment is concerned. And at a time when capital flows have become extremely sensitive with rates going up in the West, now we are seeing capital outflows, ease of doing business is becoming a very key issue. Having negative interest rates is certainly going to be very much of a disincentive, not just for saving locally, but even for investing into the country. And so the central bank obviously had to do something, I would say, dramatic, which is what I think this is a dramatic move. However, I think the central bank may also be underestimating the impact this is going to have on growth, which I think hasn't been very commendable, although many have said that our growth is okay at a 3.2. I think the central bank, let me just read from what the central bank said, 3.52%. I think that is mediocre growth, given our population and given the poverty levels and where we are. And we were just talking about Vietnam growing at 7% this morning. So for a country that is just barely growing, given the real or the growth per capita, I would think that the fiscal side has a lot of work to do, and the central bank should really have emphasized the need for those supply side reforms that will get growth on top gear, or do something that would address growth. We've seen what they try to do in the UK, although many are criticizing it. I think it's a huge effort to try and get growth up. I think there should be a similar effort to take our own growth to at least 5%, although I would say that may not be the central bank's remit per se, but clearly they should have pointed to it, because although he also said that he felt that the increase in rates would not impact the 3.52% target they had set or expectation, I think we're going to see a lot of the tempo in growth impacted by such a hike. And of course, you know what that means. Unemployment is a huge issue. Unfortunately, we don't get unemployment data. That would have been another area where I would have wanted to understand the impact or what the central bank's views are. But we never get anything on unemployment in these meetings, simply because the data, for some reason, remains very elusive for those who want to see it. But having said that, like I said, I can understand why the hawkishness, the increase of the cash reserve ratio to reduce money supply. This is war against inflation. And it's probably better to get inflation down and then worry later than to have inflation spiraling out of control, as could be the case if the central bank didn't take aggressive action. But clearly, this is not the answer or a blueprint out of Nigeria's economic issues. It simply addresses perhaps a part of it, that's the inflationary side of it, makes growth even at more risk of going down. And if we do get a recession, of course, you know what that means. Oil prices will crash. We really should be thinking about what happens next year and things that we need to do today to be better prepared for a tougher 2022.
Well said, Bode. A war against inflation indeed. How do you envisage markets and investors will react to the central bank governor's speech that just happened? What particularly struck you as market moving?
Well, the two things I think were interesting to me. One, of course, the fact that the central bank is focused on getting real interest rates out of the negative territory into positive territory. I think clearly that is a huge plus for investors. That's what they want to see. Of course, the hawkishness in the US Fed and all the other banks in Europe means that investors are not going to waste time in territories where rates are just not where they need to be. So what the decision has been made is good for investors from the perspective of competitiveness of rates. But two things still struck me. One, the interventions. The World Bank, in a paper just I think released today, although it was focusing on Asian territories, said there are two things that are likely to happen, especially as we get into the post-COVID normal. Many of these interventions are going to be found to have been lavished on zombie companies. These are the words of the World Bank, not mine. Companies that ordinarily would not have been supported by the central bank, but because of the zeal and the forbearance and the post-COVID, if you like, impetus to support, these people have got a lot of funds, which ordinarily is crowding out funds that go to more productive sectors. So really monitoring and paying more attention to these interventions is very important. Central bank has said they're going to be doing perhaps less as they try and get out of the fiscal side. The other thing that I think investors are interested in, which central bank didn't say much about, of course, is FX. I would say the elephant in the room. I guess nobody wanted to spoil the central bank's governor day by asking a question on foreign exchange. But if you look at all the headlines in the national press, it's all about getting us back to a more predictable, better understood foreign exchange system that is more market-driven. And the difference between parallel market and official market, these are all the big issues today. And the central bank, maybe I missed it, I don't think he spent time to say what is going to change in those areas. The other thing which is important, which the World Bank also pointed to in the report just out today, is the fact that high debt, countries with very, very high debt, are of course going to be leaning on the public funds, leaning on private savings, in terms of access to debt and crowding out money that, of course, is going to should have been available to the private sector. So the government is going to be borrowing money from the system. And that means there'll be less money for more productive ventures. Central bank didn't say much about this, but I think this is important, especially if we want to get the productivity up, if we want to get the economy to the levels at which it should be. And of course, the level of debt is a concern now that interest rates are even getting higher. Exchange rates is going to be an issue. The dollar is super strong. So if you're owing in dollar, you're literally in trouble. Although many are not talking about this, but you can see that this is going to have an impact on countries like Nigeria. But like I said, it's not all central banks' problems, but they are important enough for investors to be a bit concerned that they are not being addressed, because these are the things that would impact the country's, if you like, economic stability.
Well, but so did we get any sense of future guidance on rates and economic forecasts for Nigeria?
The economic forecast we did 3.52 for 2022, and I think we also got the number for 2023. I didn't pick that. But the central bank typically has been very economical with forecasts. I've noticed that compared to other banks, maybe because other central banks, maybe because of the peculiar environment and the nature of availability of statistics and the empirical models that are available to produce these forecasts. But the forecasts in terms of dot plots or in terms of future rate increases are never really very, very clear. But I can see that we are dealing with a very data-dependent central bank now. And I think to gain an idea of where the next move is going to be, I think we need to look at what the next inflation figure, which is really the main number that we have. The PMIs, which I also wanted to mention, also showing a trend downwards. 51.9 in June, 50.4 in July, 47.2 in August. That is a worrying trend. And of course, my sense is there seems to be nothing that will take that 47.2 up. But just like I said, we didn't get very clear direction in terms of where those numbers are going. But if you listened to what the central bank governor didn't say, they expect inflation to most likely go up for a while, especially throughout the election period. If we get subsidies lifted in 2023, then of course that is going to have an inflationary impact. So I don't see inflation going anywhere down in the near term.
All right. Many have said that our pace of economic growth, even though it's positive, it's nowhere near what's required to address this unemployment and poverty levels that are skyrocketing. What are your thoughts?
Well, like I said earlier, I entirely agree. I think for some analysts to be saying 3.52% is good enough for a country like Nigeria, I think is an embarrassment because it certainly is not, and it's not true, given also the population growth, which is about 2.5, even 3%, depending on which number you believe. So my sense is that the fiscal side and the monetary side need to come together. We need a plan. We need a plan to get growth to 5% plus as quickly as possible. The potential is there, given we're not like a developed country. There's so many things that can be done that are not yet done. And if you look at Asian countries, which are the countries we should really try and emulate, if you are doing anything under 4%, you're probably not growing at all. You're not seen as a growing economy if you're doing under 4% in Asia, because most of the Asian economies, Malaysia, Vietnam, they're all doing 6, 7, 5 plus percent GDP growth. And of course, you have to recognize that they have poverty to deal with, and they have huge populations as well. Indonesia, those are the types of countries that we need to really match as far as growth is concerned. And the only way to do that is get our manufacturing up to speed. We need to become a manufacturing hub within the African or the West African subcontinent.
Bode Oshasami, our business analyst.